Personal finance is not a subject which can be addressed in, say, 10 seconds, 30 seconds.
When you are putting your money to something, which is as serious as investing, because it's a hard-earned money, you pay tax on it, you work day and night. At that point in time, the idea should not be to reduce friction. So people pay attention to what they're doing. Frankly, nobody can predict the market. Don't know what curveball or a surprise might come your way. If you don't understand it, then you'll get burnt out. You don't know when the gains will come. A longer time in the market than being in the market is more important.
So I think what COVID did to everybody was swiping up for reels and swiping right for payments.
In a lot of like the tech platforms, how user experience is built is to remove friction. All of these like smallish moments, because nobody can clearly predict it.
So what actually matters?
Mira Asset Investment Managers presents a new conversational series, Let's Tech, Tech with an X. Hello everyone. Welcome to another episode of Let's Tech. Today, we have with us someone special who's seen different shows and is now in India running 5Paisa Capital. Please welcome Gaurav from 5Paisa Capital, CEO and MD.
Thank
Gaurav,
you.
welcome to the show.
Thank you.
Gaurav, I want to ask you a question about your life journey till you've reached today. You started off as a consulting business back in the US, and then over digital products.
Yes.
In different products you've built. Now you're on the retail broking side, and of course you're doing it very digitally and a wealth arm to it. But how's been this journey, and what got you interested in money management now?
Yeah, fantastic. So, it's been a fantastic journey. I started off my career I passed out in engineering, and then I started my professional life as a developer. And back in the day, started off with building the first banking product out of India. So this was in the late 90s, almost 2000s. So that started by, my journey of understanding what financial products look like, because I think one of the constants throughout my professional life is I've always been associated with financial services sector, right? So which is very dynamic, and things have really changed. So if I rewind back, let's say 25 years, we started off from like the services space to building products to digital transformation to now the AI revolution, right? And I didn't plan it to be at 5Paisa and to be in the retail broking business when I started off my career. But one thing led to another thing. And initially it was consulting in financial services, which gave me a good overview of what risk management is, how banking works, and so on and so forth. And then after consulting with multiple clients, I ended up joining the industry, which is Morgan Stanley, in the wealth management business on the product side. And it was a very interesting time, because it was about 2015, about 11 years back. And that was the inflection point of digital transformation. A lot of big companies, right? And if you take something for, let's say, magnitude of things, back then, they were managing about assets in about hundreds of billions of dollars. Now I think it's about $4 trillion.
Wow.
And still was a very heavy wealth management, branch-led model of financial advisors, right? But what they were looking at is so they didn't want to abandon this. They wanted it to see that, look, how can we go direct to consumer because of the explosion of all the internet companies out there. So a lot of contribution there, leading that charge. But it was a very realistic and practical goal. One was that build a complete D2C arm, which is direct to consumer. Second was, and with that we launched the initial robo-advisor offering, building up the digital stack and so on and so forth. But also leveraging the power of digital. So a lot of the financial advisors were not, typically we used to say back then that the average age of financial advisor was like 58. And the average age of the client was 65.
Right.
So, and that demographic, we realized that would become younger as we go by, because of generational transfer of wealth.
Right.
And what we realized back then was that if we were not digitally native, we would not appeal to the newer generation, then you will start to lose clients.
Right.
So that was the genesis of it. Build digital tools for financial advisors to empower them, so they could do what they could do, in a better fashion, more digitally empowered. And then I think one of the riskiest decisions initially, which has played out very well in my journey has been the move back to India. We did that in 2019, luckily just before COVID. In the US, you always think they call it the X+1 syndrome, which is to say that I will go back to India next year and next year and next
Okay.
year. But finally had that opportunity and had the courage to take that call, and then ended up in India, and couldn't have been a better place than Paytm to join. And there I was associated with Paytm Money, building out the initial few years of the business.
Right.
And then from there, I spent about a year or so in Singapore with a wealth tech platform. And then 5Paisa Capital happened. And so it's a lovely opportunity. I'm enjoying it so far.
Great. Thank you for that insight on the whole sort of the curve which has gone. And while you were saying this, are we in India, if you look at it now, a lot of these products and this development that you were talking about, we seem to be doing that now. Maybe 2 years before that whole revolution started. B2B platforms, digital integrations, say wealth tech for distributors. That you're almost saying that was happening in US a decade back. In that space. So are we? Would we catch up early, or it's like it's an evolution?
No, it's a great question. So I think it's a little bit on the contrary. I think India has leapfrogged because we did not have legacy. So there are advantages of legacy and there are disadvantages of legacy. The advantage is that you have a very big build base. So if we take an example of wealth management firms or general industries in the US, very fairly well developed, etc. But they had so much to, resistance initially to digitally transform because there are genuine difficulties, right? So you have to change your tech stack, you have to change your way of thinking and so on and so forth. So these transformations are always hard. The advantage of India is that we built directly digitally native grounds up. So if you look at a digital infrastructure, UPI and payments is the biggest example. The entire digital stack we have built, Aadhaar and eKYC, and a lot of our success today
is a jam stack.
It's a jam stack. For all the digital platforms, not just in financial services or in broking, but across the board. Like you look at e-commerce, you look at lending, any fintech platform is attributable to building the digital stack. So I would not say India is behind. India is actually leapfrogged. India is actually ahead. Payments, you can safely claim that it is probably the best tech infrastructure in the world, not just in India, right? And a lot of people now started to adopt that stack. They're learning from us and so on and so forth. There are certain industries which are the cusp of adopting this, and wealth management in general. If you look at wealth management, not just as broking, but also look at it like general advice and the other facets of wealth management, has generally been a slower adoption because it was been a very relationship driven, hand holding, sensitive, kind of doing business. So they've obviously taken to technology related, and that is not just true in India, but it's also true globally. But that is now changing. At least as far as the broking space is concerned, it is completely digitized. It is, everything is mostly DIY, etc. On the wealth side, we see a lot of platforms coming in and doing that as well. Along with not just the financial advisors going away, they are getting better equipped with some of these digital tools and so on and so forth. So, but long story short, I think India is leapfrogging. It is ahead. It's building its own stack. So there's a long way to go.
And in terms of this whole debate of digital sort of replacing physical presence, you just mentioned about the wealth management being, that those clients have to be treated slightly different. The DIYs, of course, are adopting to digitization. In, say, next 5 years or 10 years, where do you say this move going ahead? How will they coexist, or, one gives away to another, or?
So I don't think so one gives away to another, for sure. I think if we just take the advisor model, that is here to stay. That is, in fact, a good thing would be for a country like India for it actually to grow. So I think if you look at two aspects, digital gives you scale. So you have a digital platform, it gives you infinite scale. There are a lot of things which are made easier, and from DIY, from onboarding and selection, all the tools are in place for you to make the right decision. So if you are a lightweight investor, and if you are, somebody who believes in DIY, is comfortable doing DIY over a long period of time, it plays out very, very well. Everything is in place, especially if you look at the trading world, right? Because there's a lot of data that you have to crunch. You make your own decisions, and then digital platforms give you that execution ability. When you come to wealth, when you come to financial planning and advice, There are a lot of digital tools which are evolving. But there are times now where you actually need a financial advisor. And as things get more complicated, and with market volatility, geopolitical situation, and so on and so forth, you do end up needing a human being, because your situation might be very idiosyncratic. It might be very complex for that to happen. I mean, if there's an interesting stat that we have a very few financial advisors for the population that requires wealth management advice.
Yeah.
And if you just look at the number of registered investor advisors in India, it's very few compared to like the number of people, who are getting into middle class and then growing their wealth. So that, I think that populace is going to grow. It's not one thing giving to another. I think both will coexist. And in a way, actually, I would even go as far as to say that it will support, like what the DIYs and the tech tools do is they equip you, right? So for consumers alike, as well as for distributors and financial advisors alike, they're going to equip them like with a lot of information, a lot of analysis. So they can focus on the human angle. They can focus on your particular personal situation. What do you want? What are your goals? What are you facing? What are your fears?
Right.
What are your aspirations? And that only a human being can bring to the table.
Interesting. What you've built over a period of time with different firms, you would have looked at, say, challenges would have come up, and that's why you've gone solving those. As per you, what are the 3 critical things that people are looking forward to today from a tech perspective? And if these 3 things are taken care of, then I think the journeys are pretty much simple for people.
Yeah, so I think the first thing, which is not necessarily tech, is trust.
And how do you build that on a digital platform?
So I think the way to build it, there's no secret sauce as such, but like I would say the way to build it on a digital platform, or the way you might think that you're building it, but the way it actually gets built is through experience. So first of all is your entire user experience needs to feel very cleaned in a way that you're not hiding anything, very transparent. So I think transparency is one thing, both in terms of what your offering is and what are your pricing structures like, and what is the benefit that the customer is going to get out of it.
Okay.
The second aspect of it is how do you deliver the service, right? Which is and it starts all the way from digital marketing, how you acquire your customers. So there's an entire acquisition journey, right, which needs to feel trustworthy. Once somebody is convinced of your value and then they come and try out your platform, that means your onboarding journey. So the onboarding journey should be transparent, trustworthy, quick, and the levels of standard that are expected, right? If there are failures, there are breaches, etc., people don't like it. So that is another way of building trust. Third, most importantly, is when somebody actually becomes your customer, how they interact with the platform, what value you derive. So that is a factor of what your core product is, your offering, as well as your user experience. So that is something which is very, very critical. For example, if I'm a trader and I'm taking some trades, pricing aside, right? You could be priced a little higher, lower, whatever. Right. But over a period of time, you're saying that like whatever strategies they're making, the numbers are correct. It's fast. It is reliable. Your systems don't go down. If there is a mistake, you accept those mistakes, right? And you make the customer whole. Things like that build trust over a period of time. Nobody trusts you straight off the back. It takes years and years to build trust. And I think the good part now is that digital, like 15 years back, people would be skeptical.
Yeah.
But why would I trust somebody, with just an app? Which is now no longer the case, because it is now infiltrated all parts of our lives. And even the people who are not digital have a digital presence. Like the brick and mortar guys also have digital presence. So from that perspective, it has helped. Yeah. But you need to consistently deliver to build trust.
Print is a good example. I mean, they've all moving to digital now.
Yes.
Good example. But I think the most key thing for me that I heard from you was that in your acquisition journey, if the trust is not visible, then I think the rest of the journeys don't matter. So you build there, because people would say that if I've built something, it's very trustworthy and all, but if your first part is not right, then I think the customer is going to behave very different.
Correct.
You've probably seen that over a period of time, right?
We see that all the time. And it's a factor of your performance marketing to a certain extent, how your visuals, how your ads, so to say, for lack of better words, feel like. Yeah. What does your brand name or does it evoke trust? Right? It is not just like, either for the first time, if I'm looking at something, it'll all depend on what I'm saying,
Correct.
what is the medium, how it is served to me, etc., etc. What I would do once I know about the brand, does it evoke trust, right? What have I done in the past? So it's also about your history, right? Is there good press about you? Is there, good things people say about you? What are your customer reviews, right? So in the
Right.
digital space, it's very, very,
Very
you know,
important.
it's very important because it's transparent. Anybody will come in App Store or Play Store to write apps and Google reviews and so on and so forth. So that is something which you have to keep in mind.
So Gaurav, tell me, in your these many years of career, and you would have also advised people of what you need to do in your own financial planning stuff, not at the forefront, but from a product and a tech perspective. What do you think are the 3 common mistakes that people are doing initial part of it? And if they knew that today, they could probably correct, and that could really help them. Because most of the customers, if you look, probably have not great experience at the beginning, and over a period of time they realize that this part of the journey. But if you had that information pre-hand and if you want to share with the audience.
I think the first mistake or something that can be done better, usually people start the investing journey specifically late. When they seriously consider that investing is important. For us, I think it's mostly, for most people, it is like either you're a salaried individual or you're an entrepreneur or or a business person, whatever way of earning money. You have some, you leave it in the bank, and that's it, right? And investing could be like, doing some real estate, buying some gold, or basically doing nothing and sitting in fixed deposits. So I think that is one, because things have changed over a period of time. Mutual funds, as an example, is a great investment vehicle. And index funds are there. A lot of good investment classes which can help you build wealth for the long term. So the first mistake is not to get started. Now, it doesn't matter whether the amount is what percentage of your salary, and the amount is in absolute terms what it is, right? You need to first get started, right? So that is one. Second is that some of the initial experiences when people take some bets based on what your friend said or somebody said on the TV, and
I have a tip.
So I have a tip kind of thing that usually does not end well. Sometimes it does, but sometimes it doesn't end well, and then the euphoria dries down. I think what they need to really, my advice would be that whenever you look at something, it is investing for the long term. It is important. Everyone has a different risk profile, and you would not know what your risk profile is unless you start to sensibly start investing. So I think that is once you get through the first step, then things like asset allocation, things like long-term returns, which funds to invest in, all of those things are part of the journey, and you start to learn over a period of time.
You mentioned about long term. And that's a term very widely used by most of the managers. They're talking, or any trade expert will come and talk about it. But in reality, in practice, soon the volatility hits. It's like the child has grown up 18 years in 2 years, right? So how does one objectively look at long term and stay the course?
So my approach that I talk about is that you have to, like, if you have a certain corpus, you have to have the comfort of relying on it, which is something which is approach. So let's say you are comfortable with 50% of your corpus being in equities, right? Unless it's a 50% in more approachable and low risk things like bonds or fixed deposits and so on and so forth. Only invest that much money in the markets which you are comfortable of not touching it for a period of time, and that period of time could be as long as 7 years or 5 years or 3 years or maybe even 10 years, depending on what kind of investing you're doing. Your large caps, you're doing what time, and nobody can predict, right, when the markets are. So when the volatility hits, you say that, okay, fine, these are decent investments, I'm not going to do panic selling, and because I have this stuff lying with me which will take care of my needs in the short term. Usually what happens is that, like, you panic because you think you lost everything. So
that's notional.
That's notional. That's notional. Yes. So then you say, okay, then the psychological trigger things is that, look, I need to, even if it is 30% on, I need the rest 70% with me, and I feel psychologically comfortable, right? So even to remove that and not touch it, you need something aside, right? So you should only go in with that much money which you are prepared not to see for a few years. Now that could be 3 years, 5 years, 7 years, 10 years. Hard to say. So that would be that's the way you do it.
And does goal investing have a psychological effect on the person?
Goal investing?
Yeah.
Yeah, it does. It does. I mean, I'm not like a believer of goal investing. I think we should invest to build a corpus. Usually most people do that. Now, goal investing is great. Goal investing is just a way to compartmentalize what you. So you'll say, okay, I want to build a corpus, but for what? Maybe for your child's education, maybe for a vacation, maybe to buy a house and so on. So maybe for retirement, right? These are all goals. But usually, if you are focused on building wealth for the long term, these goals get taken care of automatically. So you could look at it that way.
So, from the current market environment, nobody knows for sure that whether any more shocks are there in the system from a geopolitical point of view. But market seems to be now sort of getting into that zone where people can just take a look back and say, okay, fine, probably we should now get back into. It seemed to be like the numbers suggest we were in like a pause activity, but things could come back and maybe GST kicks it off. What's your take on that piece where we stand today?
So see, frankly, nobody can predict the market. So today we might think that things are coming back and the whole tariff situation, hopefully, like we are saying that there is a lot of good press is coming out that we are closer to a deal with the United States and things like that, right? So, but don't know what curveball or surprise might come your way. Maybe there's another war happening, right? Or some other geopolitical tension. So, taking these short-termish kind of calls for a long term. So if you're a trader, then you need to know, right, how the market is moving at 9:15 in the morning. Or what's going to happen tomorrow. I need to unwind my positions, carry over, those kind of things. And you have to do that. If you don't do that, if you don't understand it, then you'll get burnt out. But for an investor, I think there is no, and this is my personal experience. I'm actually of the same camp as you were saying. So I will micro-analyze stuff and say that, look, is this a good time to get into the market, right? I had some money saved for like last 6 months. Decent amount chunk that should have been in the market, but it sat in the bank. And from operations Sindhu onward, a little bit before that, look, things are not good. Let me not touch it, etc., etc. But markets have kind of recovered and stuff like we put it in. Some of the good vehicles. It would have definitely beaten inflation. It would have definitely beaten the the return that I'm getting in my bank. So there is no such thing. And unless you're a market expert, a valuation expert, where you can clearly conquer both timing and valuation, don't try to do that, right? Take your horizon and stay the course. And if you don't feel like investing when you want to take a pause, no problem. There's no such thing as that you have to always do it. But if you are SIPing your way into it and continuously in the market, you don't know when the gains will come. That's what they say, right? It's a longer time in the market than being in the market is more important than all of these like smallish movements, because nobody can clearly predict it.
And to go that step, does one only look at, say, let me do the index journey, or let me bet it on the manager to do something for me? What's your take on this? Because there's a growing divide between the two.
Yeah.
So how do you look at it?
So there's no clear answer. So, but like, I'll give you my philosophy. So I think index funds are great, and just for like plain vanilla, absolutely low risk. Even if you invest in index in the market, overall market tanked for some time, usually recovers over a period of time. So that's probably the safest thing to do. That can be a core of your portfolio. When you are trying to reduce risk, depending on your your age, where you are in your journey, etc. Right. When you're younger enough, I think you can take part index and you can definitely do part active mutual funds, where you are betting, as you said, right, on the fund manager's expertise and experience over a period of time to generate that alpha. And it happens. It's not that it does not happen. So I would say you use a combination of both approaches. But obviously passive as a type of fund and the AUM in passive globally at least is, continues to grow
Right.
As a percentage of the entire pie,
Right.
which you are seeing now in India also. Like a lot of these are picking up. So that has to be an important sort of core part of your portfolio, which gives you index related returns. And then for the alpha, you take some of other exposures with some of the thematic funds or hybrid funds or flexi cap, whatever it is.
I think I like what you said. You like if you want to reduce your overall risk in the portfolio, then go to the index and build it over that, and then you can start taking those exposures and going. From a trading community perspective, we've seen the FNOs behind us now. At least, I mean, it could come back in different formats and all of it, but the investors seem to be not heading that way. So what's the next trend which you see that people could, adapt and take it there?
So see on the FNO piece, I think there are some regulations which are coming, which I think the viewers should be aware of, like tightening of the rules, etc. And there's talk on expiries being reduced, etc. Right, or longer dated expiries. So obviously there would be some impact on volumes, etc. But now it depends on the I mean, users or consumers are not necessarily traders or investors. It's a personality. So there could be an investor who, let's say, is a mutual fund person for a certain corpus that they want to be relatively safe, right? And then there's a certain part of it which they, take leverage or pledge their mutual funds, or typically like the larger players, all people, buy stocks or buy mutual funds and then they pledge it, and out of that margin they trade.
Right.
So that will continue to exist. So that could be like, okay, that, it falls out in the short term, but they'll find other asset classes. There is now growing interest in commodities as an example, and unregulated stuff like crypto, right? So people are also, I'm hearing that gravitating towards that with the FNO regulation, etc. So those things will continue to, there's no trend as such. When you're looking for like these arbitrage opportunities in the market, the people who are looking for that alpha will continue to find that in one asset class or the other, right? So really, it depends on them, what they want to do. But at the heart of it, it is not that somebody just trades and somebody just invests. Usually, it is a combination of both. And there are very few people who will be like, okay, just trade with the entire corpus, and they're comfortable. They're very comfortable. No, but on the investing side, you will find that. On the investing side, you will find that like the people who are pure investors and trading is not their cup of tea. And there is a huge population for whom the trading is not cup of tea, because it requires a lot of understanding, it requires experience, it requires a lot of dedicated time and effort to be able to, and still you may not beat the market or you may not get returns accordingly. But on the trading side, that is my view. I don't have data to back it up. I would say that like people will have some corpus, and with some corpus they would trade.
Is the same guy having a different trait, at a different product? Well, many a times we say this is a risk averse guy, but he actually could be going and say, okay, 10% of my money is going for trading, and behavior is very different to the 90%.
Yes. And I believe that's a sensible way to do it, right? Because
I mean, that then makes us think that from a cohorting aspect, we need to have this layer also. To keep in mind when somebody is doing that, because generally you will say, okay, this guy looks like he's XYZ, so let's bucket him that way. But he actually could be someone else also.
Exactly. Yeah, that's an important point, because you always compartmentalize consumer cohorts. It's not that simple.
Gaurav, in today's time, I think what COVID did to everybody was swiping up for reels and swiping right for payments. So the attention span has gone so down. And especially for finance, personal finance is not a subject which can be addressed in, say, 10 seconds, 30 seconds. It needs proper conversations and getting into mindset. How do you solve this from a tech perspective? How do you grab that attention and make him that, okay, stay longer, read more about this?
So, I mean, I think the thing to say on this is that in a lot of like the tech platforms, how user experience is built is to remove friction.
Yeah.
So, if you go to a design person, you go to a product person in this space, everybody will talk about, how can I reduce this from 5 steps to 2 steps? From start to finish, my onboarding journey takes X number of minutes. How can I bring it out X number of seconds and also, which is all great, whether it is e-commerce, whether it is, onboarding, a lot of other facets. When you are putting your money to something where it's just as serious as investing, because it's a hard-earned money, you pay tax on it, you work day and night. At that point in time, the idea should not be to reduce friction. So I always say this openly, that this is not something which you should reduce friction. You should probably increase the friction a little bit, so people pay attention to what they're doing, right? Whether it is, you're taking a trade or you're doing long-term investing. So first of all, the user experience should be designed in a way so the data is very, very clear and transparent. It is not misleading in any way. There are no dark patterns. Because from a tech perspective, you have to put attention to all of these things. Because if it is like you and I are having a conversation, I trust you, you're my advisor and stuff like that, or a friend, you will talk to me and we can talk for hours and get that. But when you're doing this in minutes, it's the user experience which is important. So it has to be transparent. It has to have all the information. There should not be any dark patterns and so on and so forth. And then on the side, whether it is on the same sort of same sequence, you have to make a concerted effort to educate. So that education, like we're doing a podcast, etc., like a lot of the digital platforms do, they have a series, etc. So that people, not necessarily when you actually, doing swipe right or swipe left, but outside of that, you try to educate so that people have information before they come to the point of buying a mutual fund, taking a trade, taking, an intraday position or whatever, right? So that is extremely important. So you have to constantly educate. And also in the interface, give them all the information, make it sure that like you're looking at both exchanges are shown, your entire market depth is shown. There are cue cards around like why you should look at these 2-3 parameters. Now, sometimes it may be possible to do it via those screens.
Yeah.
Other times you have to actually learn before you come there, right? So you have to work on both angles. So one is the actual execution phase when you're actually doing it. And second is before execution, how much knowledge that you are imparting.
So for the execution phase, let it be frictionless. From an education phase, it has to be, the guy has to be kept behind and,
Correct.
Told him multiple things. Gaurav, we are hearing a lot about algo trading, machine learning. Of course, AI advent is there. We are also seeing that now happening. But from a investing aspect or decision making, it has not yet still made the whole circle sort of, and started to take over that. We are using that to analyze data, come with patterns, and then let the human decide.
Yeah.
But on the trading aspect, it's largely the computers executing.
Yeah.
How do you see this move?
So specifically, if you talk about algo trading, today algo trading with the regulator stepping in, it basically started back in 2015, 2016, when brokers used to expose their APIs to people who were writing algos. Or so there are two parts to it. One was that there were platforms that were creating algo strategies or offering algo strategies by specialized players, and consumers were saying, okay, I'll take this algo, I will deploy capital, and then I'll connect my broker. And then, but algo is nothing but a way of basically automating your trading strategy on an asset class. So in simple terms, that's what it is. So you basically code that, when the X trigger happens in the market, you will do this, Y trigger happens, you will do this, etc., right? So it's
a rule-based.
It's a rule-based automation, right? And powered by technology, powered by more powerful APIs and execution methods, right? And there are like what we call and institutions always do this. There are white box algos now in the, if you call it in the new language, there are black box algos in which that logic is proprietary, and there are white box algos which are execution algos. So if you want to unwind a huge position, you go to an institutional broker and uses these algos to execute. What has drastically changed now is the regulators' interest in regulating and making this space very, very standard. So the new rules which have come in, which a lot of brokers we've been working on it along with the regulator, etc. It is standardizing and completely making this whole piece transparent, right?
Okay.
So and that is a phenomenal opportunity for retail to safely participate in Algo, right?
Right.
They've assigned an Algo ID, so there's a specific, whoever is running the Algo, it can be attributable to that particular creator, right?
Sure.
The brokers have to take additional higher responsibility. Earlier, the brokers were just using APIs and passing the orders. And if something went haywire,
Yeah.
they were not on the hook. Now the brokers have to take responsibility for the algos, check them, etc., right? So it is higher responsibility in all participants by step by the regulator, and then you make all the tech and operational changes and make sure that the retail participants can safely participate. So that is on the algo piece. Now on the other, like autonomous AI and generated, AI generated triggers or trading strategies. Yes, I mean it is evolving, but it is yet not autonomous that it is deciding real time what to do, etc., right? That future will also come fairly soon enough.
I think that could completely change the way even ETF trades are executed. People want to buy, but sometimes the price points, especially on some of the products where the liquidity is not that great. So if you get even a small window of opportunity, I think algo trading on ETFs could actually speed it up and quicken the execution than a human is doing.
Yeah.
Coming to today, as we stand, the country of India in 2025, looking ahead for the next, say a decade, is there 3 sectors or themes which you think are clear opportunity for investors to look at, that this is something which you should not probably miss out?
So I think from where we stand today, I would say consumption is the consumer economy is still very robust, going strong. As more and more people have more disposable income in terms of and entering the middle class, they will avail themselves of these products and services. So that's why you see even not just listed, you also see I mean, if you look at the universe and just remove companies that you can directly invest in, there are companies also in the unlisted space which are startups right now. But that basically gives strength to the entire theme, that the consumption theme is robust.
They're helping on taxes.
Yes. The second is they always call infrastructure. So infrastructure, capital infrastructure is one thing, but I would say even the tech infrastructure, because like semiconductors, data centers, building the entire AI backbone, right, which requires not just large language models, but also require computing power, right? So data centers, and those are very interesting. So you could call it the tech infrastructure play. Writing your own operating systems, building your own products, and a lot of these things are basically, you can say, indigenization theme, which is, if you take the broader the broader theme, it is indigenization of manufacturing, of tech infrastructure, and so on. So that will be second. Third, I would say is third and fourth will be healthcare, and fourth will be financials, because financials also I think is the financial infrastructure, and with increased financialization, I think there's a lot of scope for some of these players to grow.
So India digitization is the
I mean digitization goes that goes beyond. Like I would put even digitization in the tech infrastructure, which is a digital infrastructure, like continuous evolvement of payments, of identity. Now with the Privacy DPDP Act, which is coming last year, again a lot of investments will go in by enterprises into this theme, right? So how do you, for example, be able to share consumer data responsibly and without infringing on the privacy of the individual? Because now data needs to be shared seamlessly in a trustworthy manner, like almost like a token system, that I want your data for a loan that I have to give you. There are utilities coming into place. This whole account aggregator model, for example, is a great example. That is the core infrastructure which is being, and once this gets properly built out, then the apps on top of that then take over, right? And then they get the power of that infrastructure to be able to scale.
I think this can be all put into one theme, like you mentioned. That could be the theme for the next decade or so. I think that's a great insight. If there were 2 decisions in your life you would like to go and revisit in your professional career, that okay, if I could change this, then maybe this would have changed. From professional as well as money management skills.
Professional is very clear. Should I move back to India earlier? And money
That you answered X plus one.
yeah, money management should have, like it or not, I started seriously investing only 10 years back. So should have started at least a decade earlier. And the compounding that it is idiosyncratic in my case because I'm taking benchmark of 2009 financial crisis, but the same insight and the same gusto which I showed in 2016, if I'd showed in 2009 to 2012, the returns would have been astronomical.
Yeah. Market was what? 8,000.
Yeah.
It's 80,000. 10x. Okay. Yes. So, Gaurav, before we let you go, there's a question we ask everybody. A book which has had an impact and you would like to share? Movie or a web series which you want to do? And the third question is, in your free time, when you're not doing this, what is that you're doing?
Okay, so in my free time, when I'm not doing this, I actually read a lot.
Okay.
Or listen to music.
Okay.
So, and whatever time I can find and have the energy, I'll go run. So, outside of that, if I'm able to do these three things,
Bangalore weather allows you to do a run.
Yes. So I'm happy. I'm happy if I'm able to manage one of these three things. They have to be done at different points in time, but I can combine listening actively to music and running because at least 30-35 minutes of having a time by myself. So that's what I enjoy.
What sort of music you like to? Which genre?
Rock. Yeah. So Floyd and Guns N' Roses, those kind of things. Like the 80s and the 90s band.
Sure.
Gen X favorites.
You said you like reading, so.
No. Reading mostly non-fiction, right? So geopolitics, and I enjoy history a lot.
What are you reading right now?
So right now I'm not reading anything.
Book?
Last book was The Anarchy by William Dalrymple.
Okay.
So it's a book on East India Company and how they exploited and slowly became power to reckon with in India, and what are the lessons you learn from it, and very fascinatingly written. Nice. I've got the latest book from him, I think The Golden Road or something, which I've started again with the same author.
Okay.
But just not been able to finish it all.
Any book on finance you want to recommend to budding? Because this is watched by budding entrepreneurs also.
I would say more than a book. I mean, there are a lot of collections. So there is the Memo by Howard Marks. He's the founder and CEO of Oak Tree Capital, one of the largest funds in debt, I think, out of LA in US. And he writes this memo. It's known as the Memo by Howard Marks.
Okay.
I think it's monthly or weekly, but like if you go into the archives and read it, so that gives a tremendous insight on how do you look at the markets, what are some of the things you learn. I've also been an avid reader of Warren Buffett's annual letters to shareholders to pick up on the wisdoms. And then I think in today's day and age, you can always be on YouTube and listen to. I mean, Charlie Munger creates a good. Bill Gross, again, I mean, these are all global names, but again, you get a lot of the way he writes. He used to be the star CEO of PIMCO, which is the largest bond fund in the world. So his writings are extremely good, reflects. And when you read these fixed income people, right, you just don't get like sectoral knowledge. You understand macro and you understand economy and you understand history and geopolitics. So they all comes together. And actually, if you want to be a good investor, you need to understand all these aspects and not just finance. Movie, my all-time favorite is something known as Heat in 1995, which is again US movie. So I love that. Robert De Niro and Al Pacino.
Yes, masterclass. Like what we just had a masterclass on the tech piece. Gaurav, thank you so much for talking to us. And as a listener, while I was interviewing you, I'm sure the audience is going to find a lot more in terms of, especially for guys who probably want to get into this field, say build something. I think there's a lot of takeaway here that what are the things, because it's crucial from going to 0 to 1. Do you have a roadmap? And if there are certain mistakes one can avoid, and I think you've beautifully spelled them out.
Thank you.
Thank you for doing this.
Thank you. Thank you.
Thanks.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.